Yeah, this is going to be completely brain overload, so don't worry. That's why we're recording this. John, please clarify why a condor even when there's not earnings. Because so that Apple condor I'm going to do because there's a high probability of success. You're not going to get as much of a credit. You're going to have to sell that one standard deviation. Well, what's nice is with earnings, you get that high implied volatility. You can actually go out to 2 standard deviations and set up a higher success rate. Do you use the wave along with the squeeze indicator? Oh yeah, I use the wave as well. Yeah, I've just been trying to keep it fairly simple here. When will you discuss how to use the squeeze? Oh, sorry, I kind of assumed that you guys all know how to use the squeeze. I'll give you the quick tutorial here. So how the squeeze works is that when you see these red dots, what that's telling you is that the Google has gotten, so every market compresses and then expands in terms of volatility. And when it compresses too much, it just means that you're at a point where it actually has to explode. I mean, it's like it can't. It's like if you're holding like a baby puppy really tight. I mean, not tight enough to choke it, of course, but really tight. It starts squirming and it's just yearning to break free. It's the same thing with a stock. And here it's really tight to the point where it starts building up energy, and this is telling you that it's getting ready to break out. And then if the green dot here tells you that you got a trade signal, momentum's to the upside, bam, and there you go. And this is a great time to do directional plays as well. Oh yeah, so what Karen was doing was just doing exactly what I've been showing you guys here, but she would do the math and she would sell strangles 2 standard deviations out, and she'd sell them naked, and that's why she was able to grow it very fast. But naked, there's that 6% chance that you're going to get hit pretty good. Oh, how many days in advance do you do the pinning plays on the monthly? So you typically set them up on Wednesday, so 2 days in advance. John, this is close to what I've been doing. However, you're showing refines it to very good probabilities. Awesome, Doug. That's great. For those of you guys that have been doing stuff like this, I just kind of wanted to, I was hoping that you'd be able to look at this and go, ah, nice, okay. Yeah, now some squeezes will fake you out, and that's why the spreads are nice, because even if it fakes you out, you can still make max profit on the spread. All right, so let me dive into futures real quick here, because I want to show you guys a few things on futures. Yeah, Sosnoff and I always have conversations about this. It's always fairly interesting. Now, so on the futures, the main thing I want to show you here first is that, now I know a lot of you guys don't trade futures, and it's okay, but here's what I like about it. Now, in October, on the Thinkorswim platform, everybody's going to be enabled to be able to trade futures options, okay? I can do that right now. I'm kind of a beta tester for them. And what I like about this is you can actually do this exactly with what we've been doing here. And you can just sit there and say, okay, so the implied volatility on the S&P futures is 13.29%. Now, just to let you guys know, what's the difference? So on a stock, okay, on a stock, one option equals 100 shares, right? On a future, one option equals one futures contract. So that's really the main difference there. Otherwise, they're pretty much the same. I mean, you can go over here and say, oh, hey, here's the, I want to sell a call credit spread, on the S&P futures. You come over here, sell vertical, and you can see that you can get a 350 credit. And that tells you that your max profit is $175, your max loss is $75 per contract. Okay, so you can do the same thing on the futures. What's nice about this and what I like is you can actually use this. In fact, if we look at this here, you can see that we've got implied volatility of 13.29%, right? And then the price on the S&P futures is 1451.50. So then we can come up to our handy-dandy spreadsheet here, and let's just do the S&Ps, and the price is 1451.50. the implied volatility is 13.29, and let's do 5 days to expiration, meaning we want to see what's going to happen next week. And then what you can see here is what it's pricing in is a 1 standard deviation move would be 22 points, and a 2 standard deviation move is 45 points. So this is actually giving you some good information on the movement, the potential movement of the overall market next week. So if we come over here and look at the S&Ps, and we can see that where we closed, and let's just use a daily chart here, and we closed here at daily scaling center last price. So what it's telling you is that the market makers are actually pricing in that the market itself is going to stay contained in a range, okay? Not just Apple. And this to me is very fascinating and useful information. So, we saw the 1 standard deviation move is 22.58. So if we come over here, that's 14.74 to the upside and then 14.29 to the downside, right? So let's do 14.75. And then 14.29. So suddenly we've got a pretty darn valuable piece of information on the 1 standard deviation move for next week. And of course we could actually do a 2 standard deviation move as well. And we can see that if we look at that, that would take us to 2 standard deviation move would be 14.97 and 14.06, okay? So this is going to be 14.97, and this is going to be 2 standard deviations. Okay, and this will be 1 standard deviation. And this is actually great information for the markets. All right, and we already did this. This is 1 standard deviation. Oops, I'm doing this the long way here. And then to the downside was 14.06. All right, so now we've actually got some really great information for the market as a whole next week, and we can do a couple things with this. And you can also obviously do this with the spiders, okay? But background dragging, oops. So there's a couple things you can do with this. First of all, it's just realizing that the probabilities are that the S&Ps have, the stock market itself has a 68% chance of staying contained within this range, okay, and then, a 94% chance of staying contained within this range. And that's actually pretty decent information, meaning that, if the market sells off initially at the beginning of the week, this is a level to buy, okay, because the chances of it actually going much beyond that aren't very good. And there's 2 things you can do with this. You can actually buy it, if you buy futures, okay, one, you could buy the S&P futures, buy ES futures, okay, or you could buy spider calls, okay, or you could sell ES put credit spread, okay, at this level, or 4, you could sell a spider put credit spread. So if you're just playing the indexes, and that's one thing I would look at. You could also at the beginning of the week set up an iron condor and sell call credit spread here and a put credit spread here. Okay, so there's a couple different things you could do with that information that I find very useful. Okay. So commissions on the futures options are a little bigger. But what's nice is that what I like about it is that the futures options actually trade overnight. So the bonus is that, if something's crazy going on overnight, you can actually work with your options overnight. So I think that's a bonus. You could also use those to hedge. So I think it's good just to at least be familiar with them. So I like that, and so you could, so that's one thing to look at. And then the other thing is that if you like other markets too that you trade, like crude oil, well, you can do the same thing with crude oil. And you could just sit there and say, okay, well, and you could use this like on USO or something like that. But you can sit there and go, okay, well, crude oil is trading at 92.96, okay, and the implied volatility is 33.37%. And now you're actually getting some levels. In fact, well, let's use the other spreadsheet here. So crude oil is trading at 92.96. You could do this with gold or whatever. And, okay, so you can see that over 5 days, and it's having a problem, is it having a problem calculating this? 33.37. It's having a problem with a couple of these, because I think it's the, with the pricing and stuff. But the, you still got the expected move over 5 days is $4. So then, oh, yeah, sorry, thank you. Let's just call it $93, $92.96. So you expect to see a 1 standard deviation move of $3.63 for the week. So you could actually come into crude oil and just do the same thing and say, and you have to do this a little bit close, and they actually have weekly options on this, but they're not shown on here. But you could say, okay, 93 bucks plus 4, you know, that would take us to 97. All right, so 97. So you want to sell the, sell the $97 call, and then let's say, buy the 98 as protection. It's pretty volatile. It gives you an 18-cent credit. Well, what does that mean? That means, your max profit is 180 bucks. You're risking 820. Well, you can play around with that and see. And you can see it's like, or you could go a little bit lower and say, all right, well, maybe, I want to sell the 95 and buy the 96 as protection. Oh, it's a 24-cent credit. What does that mean? Risking 2. So you can do the same thing with futures, which is nice because, again, sometimes doing directional futures trading is crazy. But you can also just on the futures trade just buy, directional options as well. So I just wanted to show you that because it actually, especially on the S&Ps, gives you an idea of what the market makers are pricing in for the S&Ps to move, which gives you an overall feel of the stock market that week. All right, so I found that to be a fairly key piece of information. It's like, yeah, it is like a regression channel. So weekly options, they're on crude oil, natural gas, the grains, S&Ps, and the bonds. Okay, and here's the final piece of that. We just talked about, and this is why I wanted to tell you guys about this, is that, we were talking about, okay, high IV on stocks before earnings, right? Well, guess what happens on futures? Okay, they don't have earnings, but they have reports. So the IV on bonds, so bond IV goes up like before the before FOMC and before the employment numbers. Okay, employment, crude oil, natural gas, IV goes up before the weekly reports. I mean, the list goes on and on. So what's nice about this is that you can actually do the same strategies that we've been talking about with stocks. Is you can do these iron condors and put credit spreads on these futures and do the same thing. You're collecting that certainty. You're collecting that collapse in implied volatility. Yeah, crude before the weekly data. What is your experience trading futures options on TradeStation? They actually don't let you trade them on TradeStation for some reason. You actually have to go through their direct RGO web platform. Yeah, so you can trade future. Now, if you want to trade futures on TOS right now, here's the deal. You have to have at least $50,000 in your account, and you have to be an experienced trader. Okay? They don't want me to advertise this. They don't want me to tell people this. So if it's something that you want to try early, send Henry an email, just henry@simpleroptions.com, and he can tell you who to contact. But honestly, I would, if you don't feel like you have to do it right now, I'd wait, because they don't really want us to tell people about it. But we've been able to get a few people to do it. But what's going to happen is pretty soon, I guess in like 3 or 4 weeks, they're going to roll it out to everybody. Yeah, and some of you are already set up now, okay? And exactly, so the implied volatility on the grains before the USDA report was amazingly high, okay? So the idea is now you can use implied volatility to get pricing levels on things like Apple, S&P futures, crude oil, gold, and you can do you can still use, the nice thing about it is you don't even have to trade futures. You can do any plays that you see on the S&Ps, you can do them on the spiders, on gold, you can do it on GLD, on oil, you can do it on USO. But what's happening is you're able to have a tool now that gives you incredibly good pricing levels for the upcoming week. Okay? In fact, now in my brain I'm thinking about how can we do some kind of automatic levels that can place the implied volatility on there. So here's one thing you can do in Thinkorswim. If you guys didn't know, there's actually a pretty cool tool on there. Visually, I don't like it, so I had a little bit of an issue with it. But if we come over here and we look at this, and let me get rid of this study here. Oops. Let me get a different chart. Okay. Now, there's a couple of things you can do here on like Apple. Okay, so remember on Apple we were talking about the moves and stuff like that, and let's do this on a like a 4-hour chart. And there's actually a study that you can add on here. And if you go to Add Study and you go to Volatility Studies, and oh gosh, which one is it? Standard deviation, probability of expiring. Okay, now this gives you the probability, the one standard deviation move from today to the next monthly expiration on Apple. Okay, and then you can edit this. You go to Studies, and let's add another one. It's a volatility study, and it is probability of expiring cone. Now, I gotta be honest, I don't really use it this much. I actually prefer the Excel sheet, but I just want to show you that there are tools on here if you're more visual like this. Studies, edit studies, and so what we're going to do here then, so you can see that a probability range 68%. Okay, now if you want to change this next one to 2 standard deviations, you change it to 94%. On the other one, hit apply, and now you can see what you've got on here is that you've got so it's only giving, so it's giving you like, so for next monthly expiration, okay, so that's October expiration, oops, November, December, it's showing you, the 1 standard deviation move, so 1 standard deviation, that's 2, 1 standard deviation, that's 2, 4, all the way up into the next expiration, okay? So I find it semi-useful, but I'm not really doing stuff this far out in advance. But it is kind of an interesting tool, and do it from there. Oh yeah, and then the other thing you can do, and it's nice, is you can actually go in and edit it. So let's go in here, and we'll edit the study, and then let's do it over 5 days. So we're doing it on that one, and we're doing it there. Ah, awesome, thank you. Okay, so now it does it in 5-day Is that right? That doesn't look right though. 5 days. But it should do it like in 5 days, but it looks like it's still kind of doing it on there. But anyway, there's a few things you can do to play around with it. Let me make sure I did that right. Because and honestly, I don't use this, but I just know that I mean, Thinkorswim is smart. I mean, they've got studies on there that can help you with this. So I did 568. Okay, so I'll have to double check that. So that's the idea there, okay? So I think that's